Warren Buffett is making a big bet in one very specific area, buying over $17 billion in stocks of Japanese companies in the last few months. In fact, this entire region could be ready to take off. I'll show you why and then reveal an easy way to invest and 5 ETFs to put on your radar. The Oracle of Omaha visited Japan back in April to announce that Berkshire Hathaway had boosted its investment in the country's top 5 trading houses, Itochu, Maubeni, Mitsubishi, Misui, and Sumitomo Corporations. These were once more like import-export brokers. These companies have become the Japanese equivalent of Berkshire Hathaway. They hold big investments in companies across the economy, from logistics to real estate, aerospace, EV, and renewable energy. These trading houses have literally thousands of subsidiaries and companies, giving them a unique insight into the overall economy. And that fits well with Berkshire's strategy of owning investments across utilities, railroad, financial, and insurance. Buffett has since increased his stake even further to owning almost 10% on average of these trading houses. Think about that. Berkshire Hathaway is so confident in the Japanese economy that it's one of its biggest shareholders in these companies. And more than just Japan, there is a reason to believe that the entire Asian region could produce a standout return versus US and EU stocks over the next year. Inflation rates across developed Asia are lower than in the US and Europe. While US inflation has come down, the Fed is still raising interest rates, trying to slow the economy and prices. Europe is still battling out of control inflation and will have to continue to raise rates. Compare that with parts of Asia where inflation is coming down much faster. China is already lowering its interest rates, with South Korea and Japan expected to start cutting rates much sooner than other developed nations. And a lot of this is because most of the region avoided that kind of massive scale pandemic stimulus that we saw here in the United States or in Europe. That's left the countries in much better shape fiscally and with much lower inflation and better able to cut rates to support growth. In fact, Morgan Stanley estimates disinflation in the region is well underway and expects inflation to be within target ranges for 80% of the region within the next 3 months. That could boost forecasts for already solid economic growth in the area. Here we see estimates for quarterly GDP growth through the next year, with the US sliding for the rest of the year to hopefully rebound in 2024. The euro area is expected to crawl along at less than 0.5%, while most Asian economies are expected to post 1% or higher growth. Now, okay, I know talking about foreign stocks is about as fun as a prostate exam from Edward Scissorhands, but besides that upside potential Buffett is betting on, having just 5 or 10% of your money in international stocks can help you smooth out your returns from a stock crash in the US. Now, Buffett invests directly in the companies, but then again, he's got $1 billion and access to any stock market in the world. The best way for Main Street investors like you and me to invest is through exchange-traded funds, ETFs, that hold stocks from the region or a specific country. It gives you exposure to the entire theme, but also access to a lot of stocks not traded in the US markets, giving you access to that market in Japan. The iShares Japan ETF, ticker EWJ, up 15% this year. The fund holds shares of 237 large and mid-sized companies across the Japanese market and pays a 0.9% dividend yield. Another upside to foreign stocks is the valuation, with shares in most markets trading much more cheaply than US stocks. The EWJ trades for a price of just 14.6 times its earnings reported by the companies in the fund. That is a 27% discount to the price of 20 times earnings for stocks in the S&P 500. It's an industrials-heavy market versus what we have here in the US, where tech stocks are more than 20% of the index. With the Japanese market, you're getting more industrials, financials, and healthcare to complement your US holdings. And among those 237 companies are some of the biggest in the world, like Toyota, Sony, and Mitsubishi, along with many stocks not otherwise available to US investors, including all 5 of those trading houses Buffett is buying. Now, for this or any ETF, you can find the stocks in the fund by going to Holdings here in the menu. That will usually show you the top 10 largest positions, and then you can click on to download a list of all the holdings. This is a great way to compare the stocks in a fund with your own portfolio to make sure there isn't too much more overlap in a sector or a stock, as well as just seeing exactly what you're getting with the fund. After decades of low inflation and even deflation, Japan is welcoming a little higher prices, so it's likely to stay accommodative on its monetary policy and supportive of economic growth. It's not my favorite in the region, but when in doubt, piggybacking on Buffett's investment is always a good choice. Up more than 21% since the start of this year is one of my favorites, the iShares South Korea ETF, ticker EWY. Like the Japan fund, this one targets those large and mid-sized companies holding shares of 103 stocks in the Korean market. This is much more of an IT-focused fund, as is the market, so you've got 37% here in tech stocks, a strong fund for those growth investors and What I really like about this one is the stocks trade for an average of just 9.5 times on a price to earnings basis. That is less than half as expensive as US stocks. You've got familiar names like Samsung and LG, but also companies you might not have heard of, like Naver and Celltrion. Now, I'm not wild about the 23% weighting to Samsung, but it's a market-weighted fund, so that one company dominates the Korean market and the ETF. Inflation in Korea is coming down fast, already at 2.7% annualized, and will likely be at the central bank's target of 2% by the end of the year. The Bank of Korea has already held rates steady for 2 meetings, likely done raising rates. The next phase would then be that cutting rates to support the economy. With GDP forecasts the weakest in the region, I think the stimulus comes sooner than later, and forecasts are likely underestimating growth, which would mean a big upside surprise for these stocks. We'll get back to our list, but first, I want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week, before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign-up link below. These next 2 funds will give you exposure across the entire theme, starting with the Vanguard Pacific Stock Index Fund, ticker VLP, with its rock-bottom expense fee of just 0.08%. Now, another choice here is the iShares Asia 50 ETF, ticker AIA, but with a much higher 0.5% expense ratio. I also prefer the Vanguard Fund for its diversification and ex-China Asia strategy, where the iShares Asia Fund only holds 50 stocks and has nearly 40% invested in China. The Pacific Fund gives you broad exposure through 2,400 stocks and even some Australian exposure here. And you'll notice many of the stocks you saw in those country-specific funds like Samsung, Toyota, and Sony, along with some new ones like BHP. The PE ratio is a little bit higher here at 13.5 times because of those Australian stocks, but still much cheaper than the US index, and pays a strong 2.6% dividend. And we haven't talked about the growth regions, some of those emerging markets, but here you might want to watch the iShares Emerging Markets Asia Fund, ticker EEMA. Here you'll get exposure to 985 stocks across the region. While I'd rather it not have so much in these top 4 countries, you do get stocks from Thailand, Indonesia, and India here. It's a tech stock heavy fund, but also has exposure to financials, consumer, and communication services seen here in the sector breakdown. We've got one more fund to highlight, but as good as Warren Buffett is at investing, there is one manager with an even better record. Check out the video here for Peter Lynch's top 5 rules for investors, rules he followed to produce a 29% annual return for 13 years as the manager of Fidelity's Magellan Fund. Now, for those Chinese stocks, you've got 3 ETF choices, but I'll explain why I like one better than the others. The largest fund is the iShares MSCI China ETF, ticker MCHI, with its 2.5% yield and 0.58% expense fee. The older fund, and used to be more popular, is the iShares China Large Cap, ticker FXI, with a high 2.75% yield, but also a higher 0.74% expense ratio. My favorite, though, is the Spider S&P China ETF, ticker GXC, with its 2.9% dividend and low 0.59% expense fee. Besides the much higher expense fee, I don't like that the FXI only holds shares of 50 companies and is much more concentrated in just 3 sectors. It's heavily focused on those financials, which happens to be a lot of the state-owned banks. Now, the iShares MCHI fund is better diversified across 645 stocks and has slightly better sector diversification, though it's still going to be heavily invested in those financials. This is a good fund, though a very close second to the Spider China ETF, that GXC. This has shares of 950 companies. The sector breakdown is very close, but I do like that it has a little bit more in other sectors like IT, healthcare, and industrials. As you can see here in the price history, there is little difference between that MCHI and the GXC funds. I just like the marginally better diversification and the higher dividend yield in the GXC. Of course, China is in a far different position than most other countries. It's just out of its lockdowns, and the economy is flatlining, but on the upside, inflation is non-existent, and the government is already pumping stimulus to jumpstart things. Get free market updates with the link below, or click on the video to the right for Peter Lynch's 5 must-know rules for investing in stocks. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.